Welcome to this video. Today we're going to talk about Opendoor. Imagine being able to buy or sell a house instantly just by clicking a few buttons online. Well, Opendoor is one of the last major survivors in the iBuying revolution, aiming to make real estate deals as simple as shopping online. The stock is now up over 300% year to date and investors are starting to pay attention. We're going to find out how they make money, what they're doing, and whether this could be one of the greatest opportunities in the markets right now. So without further ado, let's dive right in. So what does Opendoor do? Opendoor is a company that makes buying and selling houses easy, fast, and convenient. This company doesn't just connect buyers with sellers, they hold their own inventory. So they buy the houses from people and they sell to other people. They make money through commission and flipping houses. Opendoor is a iBuyer company and it's one of the few survivors. So what is an iBuyer company? A iBuyer company uses computer-generated analysis of market data information on supplied by sellers, and in some cases input from local real estate agents to make instant cash offers on residential properties. Here we can see quickly how Opendoor's core business, the iBuying model, works. First, they offer a cash offer to the customer, and this all happens really fast through their website within 48 hours. Then they fix the property, they own out the property, they fix it, they prepare it, and then they put it on their own site again, and they try to resell it to another customer who's buying on Opendoor. And they try to sell for more than they bought. So they make money by buying low and selling high. And they also generate money through commissions for their service. The business model is similar to Carvana. They buy cars low and they sell them for a little bit more, and in return they give a convenient service. And they also make money through commissions. Opendoor is now basically a meme stock and the sentiment is extremely bullish at the moment. We're now looking at the charts on TradingView of Opendoor Technologies, and we can see that the stock hasn't performed well since it IPO'd many years ago. But recently, if we look at year to date, it's up over 300%. It finally turned in a bull market with a golden cross here around August. And it seems to be in a strong uptrend. So the technicals are in our favor. But is this a strong fundamental business as well? Here we can see a quick financial overview of Opendoor. We can see that the financial strength is a 5 out of 10, which is not good, but it's also not the worst. But the problem is that the company is not profitable. And you see that often with meme stocks. And if you look here, you can see that the gross profit margin are also very small. So despite having a great business model, many iBuying companies went bankrupt. So because the margins aren't as high as people expect it to be. But one positive bullish sign is that houses in the United States generally go up in value over time. And that is great, because they are buying and selling houses, and if over time these houses become more valuable, they will be richer because they have a large inventory of real estate. Another metric to know if a company can thrive in the future is whether it has a strong economic moat. So what is an economic moat? The term economic moat refers to a long-term competitive advantage that a company holds that protects its position in the marketplace. The term is inspired by the moats that surrounded medieval castles to protect the valuables within from invaders. To find Opendoor's economic moat, we can fill in here the ticker, so open, and we can analyze it. And here we can see that it doesn't have a strong moat. The economic moat consists of intangible assets, switching costs, network effects, cost advantages, and efficient scale. And the overall moat score is a 4 out of 10. And here we can see the strength and risks. So strength are strong brand recognition in the US, iBuying market, advanced data and pricing algorithms. They also use like AI to find the optimal prices. But there are risks. It's cyclical to the housing market and thin profit margins and high capital intensity. We know it's now in a technical uptrend. The 50 EMA is above the 200 EMA and there is a lot of momentum behind it. We know it's a meme stock, so we have mass psychology behind it. But we also know that the fundamentals aren't as strong. But is the company cheap right now? Is it undervalued or overvalued? Let's find out. To value this company, we're going to use the price to sales ratio. We cannot use the PE ratio, we cannot use the discounted cash flow method because earnings are negative. So what is the price to sales ratio? It's the market cap of the company divided by its revenue. And this tells how much investors pay per dollar of sales. Now let's calculate it for Opendoor. Price to sales ratio is market cap divided by revenue. And the market cap is 5.07 billion and the revenue is 4.72 billion. And then the price to sales ratio is 1.06. A price to sales ratio of around 1.1 is generally speaking cheap. But how does it compare to the competitors? Here we can see Opendoor Technologies, so Open, and it's 1.1. And Zillow is a competitor and that's 7.4. And Redfin Corporation is around 1.3. In short, based on price to sales ratio, Opendoor Technologies is looking inexpensive right now. The biggest risk I see for this company is that revenue is declining in the last few years and the net income is negative. So they're losing money and their profits are negative. So that is very concerning and that makes this company inherently a lot more risky than other companies. This is like the most recent news of Opendoor. And here we can read that Opendoor announces shareholder first dividend of tradable warrants, aligning shareholders and management. What does that mean? Instead of giving dividends to the shareholders, they now give warrants, which are essentially free call options contracts. You have the right, but not the obligation, to buy at a specific strike price in the future. So the warrants will expire like next year. And these warrants are valuable, so you can sell them or you can just hold them if you're bullish. So they do this to keep investors satisfied, and that could increase the price over the long term. I think that Opendoor is a very interesting company. I believe that this is a high risk, high reward company. And I really like the name. I think Opendoor sounds really good. It sounds interesting. And there's now a lot of hype. It's a meme stock. But always, before you get too excited, always make sure that you avoid at least these 3 mistakes. And the first mistake is don't use leverage, don't borrow money from brokers to invest. This always leads to big losses that are really hard to recover from. So companies like Beyond Meat, Opendoor, AMC, GameStop, they have extreme volatility. So if you put also leverage over that by borrowing for money, you pay interest and you have a much higher probability of a margin call, which you don't like. And once you lose a lot, it's hard to recover. Warren Buffett always talked about like rule number 1, never lose money. And rule number 2, don't forget about rule number 1. Because once you lose big, it's really difficult to recover. So the second rule is don't break your allocation rules. Only allocate a small or fixed percentage of your portfolio to one company. And the last mistake is that people fall in love with one business or stock. Never do that. Big mistake. We're now looking at the charts on TradingView again. And it's now trading at $6.56. The recent earnings were actually negative, but the revenue was more than expected. But the stock collapsed, but then it bounced all the way up, which is great. So investors still have hope. We can see that the 50 EMA is above the 200 EMA. This looks like a clear uptrend and there is a lot of hype and bullishness behind this stock. It's now a meme stock. A lot of people are diamond hands in this company. I'm willing to buy a small allocation into this stock, maybe less than 1% of my portfolio, because I think that the stock price is a little bit too high because it went up a lot since the bottom. They are losing money and they don't have a wide economic moat. And if it goes back to lower levels, I'm willing to buy more. Of course, always do your own due diligence. I hope you learned something today. Let me know down in the comments below what you think about Opendoor and like and subscribe for more videos. And I'll see you in the next one.